And William Jordan is here today of William Jordan Investments. We're going to talk about some notes that you sent over, how investors pay for their investments.
Sure.
Let's be honest, you make money.
Right.
You got kids.
Yeah,
the
good
people
call.
who work for you make
Right.
money. So there is a way that investments are set up, particularly with mutual funds, that pay anywhere from the investment manager, the fund manager, which we'll talk about, all the way down to the broker and everything else in between.
Yes.
There are different fees that are associated. Some are up front. Some are, I don't want to say hidden, but you got to look
Less
for 'em.
obvious, maybe?
So let's talk about that a little bit. And one of the things that people probably have heard of, and I don't know if this term is still used with mutual funds, loaded funds, and sometimes they're backloaded, up front loaded, non-loaded funds. You used to hear that from Fidelity all the time.
Yes.
Let's talk about that a little bit.
Sure.
What that
Well,
means.
load and no load mutual funds, that's still a common vernacular. And a load mutual fund means there is some type of commission attached to the fund, and a no load is no commission attached to the fund. So you'd assume automatically that a load fund is going to be more expensive than a no load fund. And I would
Right.
say in general, that's a true statement. Depending on how people work with advisors today or how they're acquiring mutual funds as a place to start, will determine the real cost structure, because there are many advisors who charge a fee. An RIA, a registered investment advisor such as ourselves, we charge a fee to manage funds. So it's not a question in that case of load versus no load, it's a question of what's the bottom line cost, and many load funds could have the load waived. So it's really, to me, I think the most critical factor is that an investor understands what they're paying for their asset management and who's being compensated. And I dare say 9 out of 10 clients that come into my office, if I ask them, what are you currently paying for your investments? They really have no idea. And so the encouragement I would give is stop and just ask the question. And to your point, it's not a bad thing for somebody to be compensated, whether it's the big national or international firms, whether it's an individual. Everybody's going to be compensated in some way.
Right.
It's just understanding what are they being compensated, how are they getting that compensation, and making sure it's at least somewhat transparent, because in our industry it doesn't always have to be. And as you say, it's not necessarily a hidden fee, but it may be a non-disclosed fee, or which is a frustrating factor, but it's something that investors need to be aware of, that they need to ask some of the questions. How are you compensated? What else am I paying? What are my total costs?
When years ago, when I worked for Franklin Templeton, people would call in and they'd ask at the end of the evening, what did the fund close at? And of course, what we had to give was the price, whatever it was,
Yes.
and then the net asset value. And of course, the
Yes.
net asset value is backing out those fees.
Exactly.
And so that way they knew the true investment. Yes, you have this much there, but that much of it isn't really yours. It's
Right.
just, it's part of your investment, but that's something, and it's on the prospectus for that too.
And with mutual funds, that NAV is the final arbiter, if you will, or the bottom line. What's the good news there is, even if you don't understand what you're paying, NAV is going to calculate it all. The encouragement I give to people is to really understand, though, what they're paying, because research has really shown the number one indicator of the likely success of a given mutual fund is the cost. And that means all costs. There's whatever costs are being paid to an advisor, there's costs to the mutual fund manager, there's also transaction costs. What does the fund spend to buy and sell? There's a spread when you buy and sell stocks, a bid and an ask price, and so there's a cost of doing business, almost like a real estate transaction. When you
Yes.
sell real estate, you're paying costs for that transaction. So buying and selling the same stock, you're going to sell lower than you were able to buy, which means you have to get back some of that money before you even break even. And that transaction cost can create a real drag on a fund. And in fact, the studies have said that for every 100% of turnover, times that you buy and sell your portfolio on a yearly
Right.
basis, there's almost a full percent of cost associated with that. And I kind of equate cost to a boat anchor. If you're sailing, but you throw the anchor over the boat and you're dragging it along the bottom while you're trying to get out of the harbor, you're really going against the grain there, and your boat performance is going to be worse. So you have to know what those total costs are, and you really should be asking those questions. And most times people don't stop to ask the question.
When someone does get their read about the fund, get their prospectus, and it shows those costs. Now, are they, the fund managers, locked into that cost for a set amount of time to keep it there? Or in the middle of the year, could something change drastically? We're not talking about at this point, the market going up and down.
Sure.
We're talking
Right,
about all of a sudden the fund
cost.
manager goes, wow, I think this is going to be a great thing, but it will cost.
Yes, and usually the costs in the prospectus, those aren't likely to change dramatically from quarter to quarter or even as much year over year, although they can. There's nothing that obligates the fund manager to that cost structure. But it is important to realize, we were talking a moment ago about that transaction cost or the spread between the bid and the ask price. Those costs are not required to be disclosed in the prospectus.
Okay.
And people might think, how could that be? Well, if you think about mutual funds and the history of mutual funds and when those rules were created, the turnover, the amount of buying and selling that happens inside a mutual fund as recently as the 80s was very small. Maybe they'd have, if they had 100 stocks, they might make 20 transactions for the year, a very small percentage of turnover. Today, it's not uncommon to see mutual funds that turn over 100, even 200% of their portfolio a year. So when the rules were created about disclosing costs, transaction costs were considered to be fairly inconsequential. Today, they can actually be higher than all of the rest of the costs put together. And that's why an investor has to dig in and do a little bit more due diligence to understand what's going on. And to the point about changes, that is something that a fund manager could change midstream. They might not have a lot of transactions, but in market volatility especially, there might be a lot more buying and selling, some directed by the manager, some because of inflows and outflows for the fund, and that will start ramping up the costs.
Okay.
So you want to make sure you understand what's the historical cost structure, what's the historical turnover of this fund, and is the manager there today the same manager that was creating that cost structure? Base your decision really first, as shocking as this sounds, first on cost structure. Because a lower cost structure fund, all things being generally equal, is going to outperform a higher cost structure fund, and that is true 80 to 90% of the time.
What are the differences of the different classes ABC shares within mutual funds?
Sure. That's a really good question, and it's an important distinction when we're talking about mutual funds, and it's great to be focusing on mutual funds because that's one of the most commonly held investments, and most clients, again, could not really tell you the difference. An A-share mutual fund, you pay an upfront commission. So the advisor, the broker, the representative who's offering that would receive an upfront commission. That commission, depending on how much you're investing, can be 4.5%, 5.5% of your investment. A B-share mutual fund has essentially the same commission to the advisor, but it doesn't come out of your investment up front. In exchange, they take a higher percentage out every year for the first 7 years. If somebody made a $50,000 to $100,000 investment, you could argue at the end of 7 years, it didn't matter whether you did an A share or a B share. The higher the dollar amount you're investing, the better an A share is going to be because they'll discount that commission.
Okay.
And then a C share, there's nothing usually that comes out up front, but there's a higher annual cost, and that cost is permanent. So the encouragement that I would give to clients at first is make sure you understand those distinctions. Secondly is, if you're investing any significant amounts of money, you really should be avoiding B shares.
Okay.
Sometimes in our industry, an advisor will sell a B share to a client because they don't have to say to the client, now this B share is going to pay me this amount of commission. Whereas with an A share, they're going to have to tell that client because the client's going to see it come out of the statement. And most advisors are solid, upstanding, integrity-filled people. But like any industry, there are some folks who are going to be swayed a little too much by their own compensation. So it really is on on the client to understand what that cost structure is and ask the questions.
Okay.
A registered investment advisor, which is the umbrella we fall under, generally A, B, or C, we wouldn't use B really in any circumstances, and whether it's A or C, the commission gets waived, so the advisor's charging their own management fee, and then the fund company is just charging whatever their minimum management costs are.
Okay.
So it really would be the same almost either way.
On the B shares, is that what was referred to as trailing fees or something like that? Where
Trails exist in A, B, and C.
Okay.
A shares typically pay 1/4% trail, so that means the advisor, the representative, is getting that 1/4%. B shares typically pay the same 0.25% trail, and then C shares typically pay a 1% trail.
Okay.
And again, both A and B, the advisor received a commission up front.
Okay.
It's not so much a matter of one is right and one is wrong, because I do run into clients who would prefer to pay an upfront commission, know, okay, I've got my biggest costs out of the way, and I can trade funds within a fund company, usually without incurring any additional commissions. Some clients want to pay a higher amount per year with nothing up front because they feel that that gives them more flexibility to make changes from one fund company to the next. Clients need to do their homework, understand the fee structures, understand what their advisor is being paid, and then make their own decision. And really, as a client, don't be afraid to ask the question, what exactly are you getting paid when you're sitting in front of an advisor? Now, if they're a registered investment advisor, they're going to tell you that probably before you ask, or right at about the same time you're asking. If they're just an investment representative, often they just don't want to have that conversation and they get kind of uncomfortable about it. But you have a right to know as a client.
Of course you do.
You need to ask, even though it can feel a little bit awkward.
How do the fee structures work for annuities and other similar insurance products?
Sure, that's probably the other biggest investment where it's really important to understand the fee structure. And annuities, without spending much time at all, remember there's 3 different kinds. So there's variable annuities, there's fixed annuities, and then there's immediate annuities. And the structure's different for each. Variable annuities can be very much like mutual funds. In most cases, there's an upfront commission that doesn't appear on the statement, so it's like a B share mutual fund. There are some variable annuities that work more like a C share mutual fund, but for the most part, I do warn clients to be cautious when investing in variable annuities, because in some cases, advisors will like to offer them because it pays a good commission.
Right.
There's no discount to the commission if there's more money being invested, and the advisor doesn't have to look the client in the eye and say, this is exactly what I'm getting paid. But the client, you have a right to know, you have a right to ask, you have a right to expect a straight up answer on that. So take charge of your fee structure, make sure you understand what your fee structure is. I'm paid fees, so I'm not sitting here saying people shouldn't be compensated, and a quality advisor delivers value above and beyond even just the investment recommendations. But make sure you understand so that you know where the advisor's bias maybe could lean, because most advisors, outside of the registered investment advisor space, most advisors don't have to disclose their fees, and some investments might pay more commissions than another investment. And you have a right to know, what's the commission on this variable annuity versus this variable annuity? Fixed annuities tend to pay a lower commission, and then immediate annuities tend to pay a lower commission still.
Getting back to the mutual funds, we often hear out and about different, we'll see the ads, Franklin Templeton, Fidelity, American Funds, all these. And are there certain ones that are known to be more conservative, or more, a little bit more risk takers, or a company like Fidelity that has, who knows, maybe 200 funds? I don't know, it's probably more than that now. They're so big, they may have different categories of one. This is more of a risky one, but in all that, are the fee structure different within a fund company depending on that particular mutual fund that's being offered?
Yeah, boy, that's a great question, and it's a difficult one to answer because the answer can depend. Certainly a stock market-based mutual fund compared to a bond market-based mutual fund, many companies will offer a discounted commission or fee structure on the bond market-based mutual fund. And then a no-load mutual fund company where there's no commissions that are involved, the fee structures again can be different. A stock market fund usually will have a higher fee structure than a bond market-based mutual fund. So you can generally assume that that's going to be true. And then comparing the risk side of things, most fund companies try to have a little bit of something for everyone because, like many businesses, they'd like to attract that investor's business and hope that all of their business is going to be placed with them, and then they can move from one fund to the next. So yes, funds can have different fee structures, and interestingly enough, similar risk level funds within the same fund company can have potentially very different cost structures when we start getting back to that transaction cost and the turnover aspect. So two funds with the same fund company, but one has a much lower turnover than the other, The one with the much lower turnover is probably, not always, but probably a much less expensive fund for an investor to own, and that would be the direction they would often want to lean.
All right, very good information. As you can see, William wants you to be informed. He wants you to ask those questions.
Yes.
He's not trying to hide. You go in there and talk to him, say, hey, I'm ready to sit down with you. What are you going to make on these? How does all this work?
You bet.
The more information you have, the better, and then the outcome for all parties, you and your client, are much better, and everyone's happier.
I think when everybody knows what's going on, everybody
Yes.
has a greater level of comfort, and most
Yes.
clients, they know their advisor's being paid something, but they just don't know, and they sometimes feel embarrassed to ask, and so just take control of that. And for folks who live here and watch your show, we offer a free fee cost analysis of someone's portfolio.
Oh, great.
So
That's a
we'll
great-
scrub their
great
portfolio
service.
and tell you, here's exactly what you're paying for your current investment management. And in many cases, I can give them a thumbs up and say, hey, this is a pretty solid portfolio. And in some cases, it's really shocking how expensive the funds are. And that doesn't mean the advisor's gouging fees. That the cost might just be because of the transactions and the fund management costs. So it's important to do that analysis. If somebody's in the boat where they want to do it, but they're not going to take the time to do it, they can contact us, tell us they saw us on your program, and we'll do that as a complimentary service.
Excellent service. William Jordan Investments. You can see the number on the screen, 949-916-8000. And thank you for coming on. Good conversation, good information.
My pleasure.
It
It's
can be
always fun.
confusing for people, but William
Yes.
can help you out. All right. You take care.
Thank you.
We'll be right back. It can be.